So we didn't quite finish part one yesterday. And the reason I wanted to wait and not try to rush it is that we're getting into things that are a little, I don't know, just different and that worth taking a few minutes to do. But we do have to still kind of hurry because we have to finish all of part two as well. So yesterday we talked about the journal entries for when a company issues stock, meaning they sell a portion of their own company to raise funds. And remember, we looked at both common stock and preferred stock. And in each of the cases, we were issuing it for cash. And then we talked about dividends and how dividends were paid out in cash. So we looked at all those entries. Dividends aren't always paid out in cash. There's times when a company wants to pay a dividend to its owners. So the board of directors agrees to pay a dividend, but they don't have tons of cash. So instead, what they do is they pay a stock dividend. They give out a certain, so for every 100 shares you have, you get like 1 share of stock. So a stock dividend involves issuing more stock to be given to the shareholders to pay them a dividend in stock rather than paying them in cash. Okay. So I want to show you how to do that. It says, assume that a stockholders' equity account of Hendricks Corporation as of December 15th is as follows. So you can see they have common stock, $20 par, 2 million shares are issued. They have paid in capital in excess of par, meaning when they issued that stock, they got an additional $9 million more in capital than just the par value of the stock. And then they have retained earnings of 26,600. So one thing they might do is pay a stock dividend, which will take some of that retained earnings and in essence use it to issue some more stock without getting any new cash. Okay. So on December 15th, Hendricks Corporation declares a stock dividend of 5%. This is how they'll be done in problems, or 100,000 shares. So when they say they're declaring a stock dividend of 5%, it means you take the existing number of shares, 2 million, multiply that by 5% or 0.05, and that tells you how many more shares they're now issuing for this stock dividend. So 5% of 2 million is 100,000 shares. And then it will also tell you, so to be issued January 10th to stockholders of record on December 31st. So we still have those 3 dates: the date they declare the dividend, the date of record, meaning that you have to be a stockholder as of that date to get the dividend, and then the date of issuance when they're actually going to pay the dividend. So the market price of the stock on December 15th, the date of declaration, is $31 per share. So the way we're going to record that then is we're going to say, all right, they're issuing 100,000 shares, $20 par stock, and we're going to use the market price of the stock for how much they're issuing it for. So $31 per share. So just like we did before, we'll say like, okay, so that's 100,000 shares times the par value. And then to find the additional paid in capital, we'll do 100,000 shares times the amount of cap, or the price of the stock over and above the par value. So if it's $20 par stock, they're issuing it for 31, then the additional paid in capital will be $11 per share, right? So those two will add up to the total 31 market price. So that's going to be 20 million. And that's going to be 11 million. Oh, no, sorry. I added too many zeros. 2 million and 1,100,000. Zeros matter in accounting. Like fired matter if you make too many mistakes with a factor of 10. Yeah, anyway. All right. So the journal entry will look like this. We will debit stock dividends, $3,100,000, and we'll credit stock dividends payable, or sorry, distributable is the word they use, meaning they haven't done it yet. They won't do it until the actual day of issuance. And then we'll credit paid in capital in excess of par on the common stock. Um, so that looks a lot like the cash, but instead we're just doing we're doing this stock dividends distributable. Then when we actually issue it, we'll do a debit to stock dividends distributable and a credit to common stock. So that's how we do it. So let's look at the last question in guided assignment part 1 so we can get that done. So this is Healthy Life Company. It's an HMO for businesses in the Fresno area. The following account balances on Healthy Life's balance sheet: common stock, 3 million shares authorized, 2,200,000 shares issued, $15 par. They have 33 million in paid in capital in excess of par. Oh, sorry, no, that was the 33 million is the total common stock, and then 9 million is paid in capital in excess of common stock. They have retained earnings of 89,500,000, and the board of directors declares a 5% stock dividend when the market price of the stock is $18 a share. So as you can see with this kind of problem, they're going to barf information all over you. Like they're going to give you so much information that it's easy to like get lost in it. And so you got to like break it down piece by piece. So they want us to journalize the entry, to record the declaration. And so the first thing we need to do to be able to journalize that entry is we need to figure out how many shares of stock they're going to be issuing as part of this dividend. So if it's a 5% stock dividend and they have 2,200,000 shares issued, we take 2,200,000 times 5%. Can somebody do that math for me really quick? Trying to speed it up, but I don't know if that will actually speed it up. So that's the number of shares are already outstanding of this stock times the amount of the stock dividend, 5%. Yeah, what'd you get? 110,000? So they're going to issue 110,000 new shares of stock for this stock dividend. Okay. And then to figure out the amounts involved, we're going to take 110,000 shares because that's how many shares we're issuing times the par value of the stock, which is $15, and 110,000 times additional paid in capital, which I think they said it was being issued when the market price was $18 a share. So that'll be $3 more. Okay. Anybody have those numbers? 110,000 times 15. Work with me, people. What was it? 1,650,000. And then I think we can do 330,000 is the other one. I did it in my head. I'm so smart and humble. Both of those two things combined. All right. So we have the dollar amounts involved now in this stock dividend. So we're going to debit stock dividends and we're going to credit stock dividend distributable and paid in capital in excess of par common stock. And then we're going to use these amounts. So I'm going to do stock dividend distributable, 1,650,000. Paid in capital in excess of par, 330,000. And then the two of them together added up will be the amount that I'm debiting to the stock dividend account. So what is that? 1,980,000. Let's see. So the next question says journalize the entry to record the issuance of the stock certificates. So when we actually issue the stock certificates, we're just going to debit stock dividend distributable and credit common stock for the 1,650,000. So in essence, we're taking the stock dividend distributable account, and we're now taking it back down to zero by debiting the account by the same amount as we credited it earlier. And now the stock account, common stock account. So this will have the overall effect then of increasing our common stock account by 1,650,000 and increasing our paid in capital in excess of par by 330,000. So what we're doing here is we're giving the shareholders these shares. Okay. So in essence, every shareholder is going to get 5% more shares than they currently have. This is a way that we can share the profits with our shareholders while preserving some of our cash, especially let's say we were going to be doing some expansion, building a new building, and we needed cash, but we still wanted to pay a dividend. So we pay them in shares of stock rather than cash. We keep our cash, but we do further dilute our ownership, right, by issuing more shares, meaning now the other shareholders own more of the company than they did before. All right. Determine the following amounts before the stock dividend was declared. Oh, before it was declared, the total paid in capital, the total retained earnings, and the stockholders' equity. So before it was done, we had 220,000 shares issued, $15 par. So that was 33 million and 9 million. So total paid in capital just means our common stock account plus any paid in capital in excess or in addition to par. So it just means the amount that we've been paid for our stock by the stockholders. Okay. So we're just going to add this 33 million and this 9 million, and that'll be our total paid in capital. So 33 million plus 9 million is 42 million. Our retained earnings, I think, was given to us up here, 89,550,000. And then the two of these added together, our paid in capital and our retained earnings, that's going to be our total stockholders' equity. So 89,550,000 plus 42 million should be 131,550,000. So this goes way back to the beginning of the course where I taught you that our equity, in other words, the amount of the business that the owners own, can only be either contributed capital, meaning money put in by the owners, or retained earnings, or money earned by the business. Okay. So here we just look at paid in or contributed capital plus the amount of retained earnings, which means money the business earned over time. We add those together and that gives us the total stockholders' equity. Now it wants us to determine the following amounts after the stock dividend. So now we've issued more stock. How much more? Well, 110,000 shares. That much is the common stock amount of them or their par value. And this amount is the additional paid in capital. So if we just take the 42 million we had before and add this to it, that's going to give us the new total paid in capital. Okay. So 42 million plus 1,650,000 plus 330,000 gives us what is it? 43,980,000. How do you think we paid for that? Like we just can't produce money out of thin air. What we had to actually do, and what will happen at the end of the year when we close our accounts, is we always close dividends to retained earnings, which means we'll take our dividend amount, which was 1,650,000. And at the end of the year, we'll credit dividends 1,650,000 and we'll debit retained earnings for that. So we pay for stock dividends out of retained earnings. Okay. So we're going to take what that retained earnings was before, which was 89,550,000. We're going to subtract the amount of the dividend we just paid, 1,650,000, and that's going to give us the value of our dividends after the stock dividend. Then if we add the two together, that'll give us our total stockholders' equity. Oops. And surprise, it's, oh, no, I didn't need one more zero. It's the same as it was before. So in a stock dividend, all that's happening is we're taking our retained earnings, which is one form of stockholders' equity, and using it to purchase stock, which we're then going to give to the owners. So in essence, we're converting retained earnings into paid-in capital. Our options would be all dividends are really taking retained earnings and paying them out to the stockholders. We could either do that in cash, or we could do that by issuing more shares of stock to them. But in the end, our total stockholders' equity is the same. We've just redistributed it from retained earnings, money the business has earned, to paid in, meaning instead of giving them the cash, we gave them more shares of stock. So that's what's going on when we do a stock dividend. All right, so we need to move forward just from a time perspective, since we had to take, yes. Okay. All right, so let me bring up this one here. All right. So another thing we'll see come up when it comes to dealing with stock is a stock split. Some major corporation just had a stock split. Amazon? Somebody just did a stock split. So a stock split has to do with as a company's stock value grows, sometimes it becomes less and less attractive to investors. So nobody like wants to buy a stock that costs $1,000 a share. It just seems like too much. Even though it might represent the true valuation of the stock, there's just sort of a psychological factor about stock prices getting too high. There's a few companies like Berkshire Hathaway. Has anybody ever heard of Berkshire Hathaway? It's owned by Warren Buffett, or he's the primary owner. And he's one of the richest people in the world. He's anyway, he purposely has never split his stock and just let it grow from when he started the company. And I don't even know what it is right now, but probably $200,000 or $300,000 a share. And he does that to discourage inexperienced investors from buying his stock. In other words, it's like they like institutional investors and others to put money into that. But most companies will do a split, which will in essence reduce the cost of the stock, but will increase the number of shares that are outstanding. Also, if your charter only allows you to issue so many shares, this is another way to get more shares out there by splitting the stock. So all a stock split does is, so here's a stock that has 4 shares of $100 par value per share, which is $400 total par value. And then if they do, this is called a 5-to-1 stock split. All you would do is multiply the number of shares by 5 and divide the par value by 5. And so now it would have 20 shares of $20 par value stock, which would have the same total par value. Okay. This is a good thing when you're a shareholder, because you're getting twice as many shares, but the value of the shares is half of what they are. For a 2-to-1 stock split, you get twice as many shares and the value is half of what it is. But now as the stock grows again, you have double the shares. So if it goes up by $1, you're gaining $2 instead of if it goes up by $1, you're gaining $1. Does that make sense? Kind of. So all a stock split does is it increases the number of shares but reduces the par and market value per share of the stock. And it's typically done when a company wants to either keep their stock price low, but without harming their investors. So the investors are still going to have the same value, or if they want to be able to get more shares out on the market than what their original corporate charter allowed for them to do. Okay. So that's what a stock split is. So let's look at a couple questions in chapter 12, part 2. So you can see what that looks like. All right. So Willie's Grill, Wiley's Grill, 2 L's, I think is Wiley. I don't know. Maybe it's Willie. Their grill and restaurant corporation wholesales ovens and ranges to restaurants throughout the Southwest. Willie's Grill and Restaurant, which had 325,000 shares of common stock outstanding, declared a 3-for-1 stock split. So the first question is, well, how many shares will there be after the stock split? And the answer is 3 times as many. Okay. So if they had 325,000 shares and they do a 3-for-1 stock split, I just take 325,000 times 3. Now there will be 975,000 shares of the company out there. So again, not super hard. Okay. All that's happening is if there's a 3-for-1 stock split, we'll multiply the number of shares by 3. If there's a 2-for-1 stock split, we'll multiply the number of shares by 2. 5-for-1 times 5. That's all. Okay. So it has the effect of increasing the number of shares, but it also reduces the price of the stock. So Willie's had a market price of $450 per share before the stock split. So the approximate price per share after would just be to take the market price before the split and divide it. So if it was a 3-for-1 split, we'll divide by 3. So now it's $150 per share. So again, this has the effect of meaning the market capitalization, which is the number of shares outstanding times the price, doesn't change because we tripled the number of shares, but took the price of the shares down by 1/3. And so if you're a stockholder, if you're, if the amount you owned was worth $10,000 before the split, it'll still be worth $10,000 after the split. It's just that you'll now have 3 times as many shares that are at 1/3 of the price. Doesn't hurt the stockholder. In fact, it benefits them so that as Willie's continues to grow, now they're getting 3 times the growth out of those shares. For every dollar it goes up, they're going to get 3. All right. So that's a stock split and the basics of how it works. And then the second question. So here are transactions completed by Canyon Ferry Boating Corporation. They want us to journalize them. So it says on January 8th, let's see, they split the common stock 2-for-1 and reduced the par from $100 to $50 per share. After the split, there were 300,000 common shares outstanding. So they want us to do the journal entry here. I feel like they're trying to be tricky on us. So here's something interesting. With a stock split, nothing happens from an accounting perspective based on the split. Because the split, our accounting transactions don't ever really take into account how many shares there are. It's just the total amount of the par value of the stock. Okay. So the fact that we split the stock is still going to be no entry required. There's no journal entering required for a stock split. On April 30th, though, they declared a semi-annual dividend of 60 cents per share on 16,000 shares of preferred stock and 22 cents per share on the common stock, payable on July 1st. So we have to know, so we know it tells us how many shares of preferred stock there are. So if it was 60 cents per share and there were 16,000 shares, we can pretty easily figure out what that is. So our preferred dividend is the number of shares of preferred stock, 16,000, times the amount of dividend per share, which is 60 cents. What is 16,000 times 60? 9,600? What is it? Okay. So that's the amount of preferred dividend they're paying. And then it tells us 22 cents per share on the common stock. And we have to look up above here where it tells us that there were 300,000 common shares outstanding after that split. Okay. So we're going to do 300,000 shares of common stock times, how much did it say? 22 cents per share. What is that? 666,000. So that would be the dividend on the common stock. We add those two together, that gives us the total amount of the dividend, which is what, 75.6? So our journal entry is going to look like this. On April 30th, cash dividends. And then we're not going to pay them until July 1st. So we're going to call them cash dividends payable of 75,600. That's the other thing, is after a split, now you have more shares. So when they pay a dividend and dividends come per share, you get more dividends. And then finally, when they pay the cash dividend, we're going to debit the cash dividends payable, getting rid of the liability, and credit our cash. We're actually paying out 75,600 in cash. All right. On October 31st, they declared semi-annual dividends of 60 cents per share on the preferred stock and 11 cents per share on the common stock before a stock dividend. In addition, a 5% common stock dividend was declared on the common stock outstanding. The fair market value of the common stock is estimated at $56. Okay, that's a lot. That's a big mouthful. Again, like I told you, sometimes it feels like they really hit us with a lot of information on these. So let's start and just figure out our cash dividend. If it's 60 cents per share on the preferred stock, that's the same. And then if it's 11 cents per share on the common stock, then our total dividend there would be 9,600 preferred stock plus 33,000 common stock, which is 42,600. So that's pretty doable. We'll debit cash dividends, we'll credit cash dividends payable, and we'll do the 42,600. Also, we're going to have to record the stock dividend. They tell us they're going to do a 5% common stock dividend. So I'm going to debit stock dividends. I'm going to credit stock dividends distributable and paid in capital in excess of par on the common stock. And it says it's a 5% common stock dividend. So if I had, what was it, 300,000 shares? Yes. 300,000 shares of common stock times 5%. That means we're going to be issuing an additional, what, 15,000 shares? And then to figure out the amounts, we'll do 15,000 times the par value. What was the par value of this stock? Somewhere it told us. $50 per share, right? Because up at the split, it said the split reduced it from 100 down to 50. So we're going to do $50 a share. That'll give us the par value. And then the additional paid in capital will be, if the market value was 56, we're going to take another 15,000 times the $6 of additional paid in capital. That'll give us the amounts we need to do the journal entry. So 15,000 times 50, anybody know? That's 750. Is that right? Okay. And what's 15,000 times 60 would, or times 6 would be 90,000. So there's the amounts we need to do our entry, okay? So the amount of the stock dividend distributable is going to be the 750,000. We're going to credit that. Amount of the paid in capital in excess of par is going to be 90,000. And then if we add those two together, it's going to be 840,000. That's the amount of our total stock dividend. Finally, on December 31st, they're going to pay the cash dividend and then issue the certificates for the stock dividends. So to pay the cash dividend, we're just going to debit cash dividend payable and credit cash. That's a pattern we've already been through a couple times now. That's for the 42,600. And then we're also going to debit the stock dividend distributable, 750,000, and credit the common stock, 750,000. So there's a lot going on there, but if you break it down piece by piece, it's not too horrible. We'll check our work. Can't really say it's not too horrible and then get it wrong. So good thing we checked our work and it was right. All right, still more concepts to cover. So let's look at a couple more things. All right, so treasury stock, I mentioned this yesterday, is stock that the business has issued, but then it buys back into the treasury of the business. Again, we do that because when we issue stock, it's to raise funds. But as our business grows, we might want to buy that back from the shareholders, so less of the company is owned by other people. Okay, so treasury stock is stock that has been issued, but then reacquired by the business. So if here's a corporation, they have the following paid in capital. They have common stock, $25 par, 20,000 shares authorized and issued. So 25 par times 20,000, 500,000. And then any excess or additional paid in capital over and above the par was 150,000. So here's some transactions they do, and we'll show how to record them. So on February 13th, they purchased 1,000 shares of their own common stock from the market at $45,000 a share. On April 29th, they sold 600 shares of their treasury stock for $60. On October 4th, they sold the remaining 400 shares of treasury stock for $40 per share. We don't pay any dividends on treasury stock because, well, it's being held by the business and dividends are to be paid out to the shareholders. So when the business holds them, we just don't pay on it. So that first transaction, which was to purchase 1,000 shares of its common stock at $45 per share, is that they debit treasury stock and credit cash. That's what it looks like. Then here they sold 600 shares of that stock for $60. So they're going to take $60 times 600 shares, which is 36,000. They're going to record the treasury stock a credit at its par value and then any amount over and above that as paid in capital from sale of the treasury stock. And then finally, on October 4th, they sold 400 shares for $40. So here you can see that they, again, 400 shares times $40 is $16,000 in cash. And they're going to debit the treasury stock 18,000. And here we're going to end up, credit the treasury stock 18,000 and debit the paid in capital. So you'll notice up here, they credited paid in capital in excess because they sold the stock for more than its par value. Here, they sold the stock for less than its par value, so they debited that amount. Okay. All that's really happening seems a little confusing, but all that's really happening is they're buying their own company stock from the open market and holding it now within the company. And then sometimes you sell it back if you can make a profit on it. So let's look at one of these problems, 1214, which is the third one on the guided. Where are you at? There you are. So Mystic Lake Incorporated bottles and distributes spring water. On July 9th of the current year, Mystic Lake reacquired 60,000 shares of its common stock at $42 per share. On September 22nd, Mystic Lake sold 45,000 of the reacquired shares for $51 per share, so they made a profit on them. And the remaining 15,000 shares were sold at $40. So this is very similar to the example we just looked at. Okay, so let's look first at what happens when they reacquire or purchase their shares. Anytime a company purchases their shares, we're going to debit treasury stock and we're going to credit cash because they're buying these shares of stock. And how much is it? Well, it was 60,000 shares times $42 per share. $2,520,000. Something else you'll notice is that most of the time, our stock, like common stock, its normal balance is a credit, but treasury stock has a normal balance of a debit. So when we're looking at our stock outstanding, we would have our common stock minus any treasury stock would give us our total amount of stock outstanding. So that's why it's a debit, because it's reducing the amount of stock value that's out there. Okay. On September 22nd, they sold 45,000 of those reacquired shares at $51 per share. So we're going to debit cash since they're selling it. We're going to credit our treasury stock because we're getting rid of some of that treasury stock. And we're going to credit paid in capital from sale of treasury stock. So to do the treasury stock, we're just going to take the number of shares we sold times the par value. Does it give us the par value? Actually, we're going to do the number of shares we sold times what we paid for the shares. So if we paid $42 per share and we're selling 45,000 of them, I'm going to go 45,000 times $42. That's going to be 1,890,000. And then this paid in capital from sale of treasury stock is just going to be any profit we made by selling that treasury stock for more than what we paid for it. Okay. So if they paid $42 a share when they bought it and they sold it for $51 a share, I would say 51 minus 42, $9 a share in profit. So I would just take the number of shares they sold, which was 45,000, times the amount of profit they made per share, $9, gives us 405,000. Add those together, and that tells us how much cash they made from the transaction, right? $2,295,000. So anytime we sell treasury stock, we're going to record a credit to treasury stock of the number of shares we're selling times what we had paid for those shares when we acquired them. And then also the number of shares we're selling times any amount over and above what we paid for them for the paid in capital from sale of treasury stock. Those two figures together will add up to the total cash we received from the stock. Okay. November 23rd, they sold the remaining 15,000 shares for $40 a share. So again, we'll debit cash. And on this one, we're going to end up debiting the paid in capital for the sale of treasury stock because we're selling it for less than what we paid for it and treasury stock. So if they sold it for $40 per share, we're going to do, let's see, how do we get that number? We're going to say we sold 15,000 shares. And so we still multiply it by what we paid for it. So I get 630,000 here. So we're reducing our treasury stock by the cost of that treasury stock. But we actually didn't get full cash for it, right? We got negative $2. We lost $2 on each one. So I'm going to take $2 times the 15,000 shares, which is 30,000. And I'm going to debit that to the paid in capital from the sale of the treasury stock. And again, together that will tell us that we got 600,000 in cash. So on that second sale, they got 600,000 cash for something they paid 630,000 for. So they lost paid in capital from the sale of that treasury stock. They had a loss on it. The first one, they made a profit. All right. So now what's the balance of the paid in capital from sale of treasury stock on December 31st? Well, up here, we had a credit of 405,000. Here we have a debit of 30,000. So 405,000 minus 30,000 is we're going to have a $375,000 credit balance in that account. Does that make sense? We did it like a T account. Put the 405 on the right, the 30,000 on the left. Find the balance is going to be 375 on the credit side. For what reasons might Mystic Lake Inc. have purchased the treasury stock? So to support the market price of the stock, that might be one reason to buy your own stock. Right? As you buy it, it holds the price up. Provide shares for resale to employees. That's another reason. For reissuance to employees as a bonus, sure. Or all of those. I'm going to put all of those reasons. All right. So what does all this look like on the balance sheet? We've been doing a lot of transactions that impact the stockholders' equity section of the balance sheet. And so we can see here's the paid in capital. They have preferred stock listed. Any excess over the issue price gives us our paid in capital for preferred stock. Then the common stock, any excess paid over the par price gives us our total paid in capital on the common stock. And then here they made money from the sale of treasury stock. So all of that adds up to be their total paid in capital. Then we add our retained earnings, the total of the paid in capital, meaning all of our stock, plus our retained earnings gives us our total stockholders' equity. And then they subtract treasury stock from it. And that will leave us with our total stockholders' equity. So that's a lot. Before we kind of just had common stock. Now we've learned about preferred stock. But again, all we have to know is we're going to have our preferred stock plus any paid in capital in excess of par, which we've learned how to do the journal entries. That means we got more money than the par value for the stock when we issued it. Then we're going to have the common stock plus any paid in capital in excess of the par. Then they made money in this case for the sale of treasury stock, which is the total amount of their stock, plus retained earnings, minus any treasury stock. That's how it's going to look on a balance sheet. Okay. So it's not different from what we did before. It's just way more detail added than to what we've looked at before in the stockholders equity section. All right. So another problem. So just so you guys know, there's 2 minutes left in regular class time. You are free to go if you need to. You're also free to stay if you want to. This is being recorded, so if you need to go, I will put it up on there and you can finish up. But I'm going to go ahead and work through it, okay? Because this is my office hours after this anyway, so I'm just going to flow into those and keep working. But I don't want you to feel obligated to stay and be late to another class if, I'm just letting you know. This chapter took us a little extra time. So let's look at question 4. So they want us to do the stockholders equity section of the balance sheet. So the following accounts and their balances appear on the ledger of Gooddale Properties, Inc. We have common stock, paid in capital from the sale, paid in capital in excess of par on the common stock, retained earnings, and treasury stock. So we're going to go ahead and we're going to list our common stock, $45 par, 80,000 shares authorized, 68,000 shares issued, and that's $3,060,000. And then it tells us there was paid in capital in excess of par on the common of 272,000. And they're going to total up to paid in capital on the common stock. So 3,060,000 plus 272 should be 3,278,000. Is that right? No. 3 million. Oh, 300 and I should just get out my calculator and do it. Trying too hard to do it in my head. There we go. 3,332,000. That's the paid in capital from common stock. We have some capital from the sale of treasury stock somewhere. Paid in capital from sale of treasury stock, 115,000. So the two of those together will add up to be our total paid in capital, 3,447,000. Then our retained earnings. We add those together to get our total, which looks like it comes out to 24 million. And then we're going to subtract our treasury stock. So 24 million minus the 324,000 in treasury stocks going to give us a total stockholders equity of $23,676,000. So again, all this was intended to do is show us what that, with now that we know all of this additional detail, this one doesn't have any preferred stock, but we're always just going to have the stock plus any paid in capital over par, those listed first. Then if we made any additional money from sale of treasury stock, and all those will add up to our total paid in capital. Then our retained earnings, which means money the business earned from doing business, And those together will give us a total minus any treasury stock, which is outstanding stock of the business that the business has bought back in, will give us our total stockholders equity. So they're just, just follow the pattern. If you get stuck doing it, go to the book. It will show you, it'll show you one of these, and you can just follow that format. All right, one more question. Well, one more concept. Let me show it to you real quick. So this is just another one of these ratios we learn about. This one's called earnings per share, which is another way of saying how much profit does a company make divided by the number of shares it has out. So the earnings, which is our net income, minus any preferred dividends we paid out, divided by the average number of common shares outstanding. Did you guys, I went quick through that. You want that formula? All right, give me a second here. I realize I'm rushing. I'm sorry. There it is. So net income divided by preferred dividends. I'm sorry, net income minus preferred dividends divided by the average number of common shares outstanding. And by average number of shares outstanding, it means take the number of shares at the beginning of the year plus the number of shares at the end of the year, divide by 2, right? We've seen that pattern a few times now. All right, you guys ready to move to the problem? Get it over with? End your pain? All right. So here's financial statement data for Black Bull Incorporated. I don't know if they're like a rival product to Red Bull. I don't know. Anyway, so it gives us the net income, the preferred dividends, and the average number of common shares outstanding. So actually, we don't have to figure out the average, it's telling it to us. So to find our earnings per share, then we're just going to take the net income, 1,538,000, minus the preferred dividends, and then divide that by the average common shares outstanding. So for 2025, I get 18.6. That means the company is earning $18.6 per share or outstanding share. In 2026, we'll do the same process. We'll say net income, 22,485,700 minus the preferred dividends. Divide that by the average number of shares outstanding. And I get 21.18. Typically, with this, higher is better. Having more earnings relative to the number of shares you have is considered a positive thing. So we're going to call this a favorable change. All right, thanks for staying with me an extra 5 minutes or so. I guess I should check it, make sure we're all good. And I hope you have a great day. Thanks.